Hello and welcome to the St. Charles City County Library. My name is Elizabeth Nelson, the Classes and Events Coordinator. Thank you very much for joining us on Facebook Live tonight for the second of 3 Money Smart Mondays with KMOX's Charlie Brennan. Money Smart Mondays are part of Money Smart Month. Every April, the library partners with Money Smart St. Louis to bring free, informative financial literacy classes and events to you. We've got a great lineup this year and something for everyone, kids included. This event is just one of over 75 free Money Smart Month financial education events that are occurring all over the St. Louis metro area. Money Smart Month is a community education initiative sponsored by the St. Louis Regional Financial Empowerment Coalition with in-kind support from United Way of Greater St. Louis. The events are also made possible by funders, including Stifel Bank, Commerce Bank, Midwest Bank Center, and many others. You can find out more at moneysmartstlouis.org. Back to tonight and Money Smart Mondays. Charlie is the host of The Charlie Brennan Show with Amy Markskers and provocateur of Donnybrook on KETC TV 9 network of public media. He is a St. Louis Radio Hall of Famer and author of several books about St. Louis. Charlie is a great friend of the library who's been with us for several events over the years, most recently for his book, Only in St. Louis. This evening's Money Smart Mondays guests are Adam Grossman and Brad Stinn, who are here to help us newbies get started with financial planning. Adam Grossman is a financial planner and the founder of Mayport Wealth Management. Mayport's mission is to help lower the cost of financial advice for consumers. Unlike traditional firms in the wealth management industry, Mayport works with clients on a flat fee basis. Adam has written several free ebooks available on Mayport's website and is a contributor to the personal finance website Humble Dollar, where he has written a weekly column since 2017. Adam lives with his family in Boston, where he has served on the finance committees of local schools and nonprofits. He holds an MBA from the Sloan School at MIT. We also have Brad Stinn with us tonight, author of The Roadside Scholar, Amazing Money Lessons from Inside the Feds. Brad was a federal inmate for 10 years. During that time, he taught investment, business, and GED classes to inmates. He is a Harvard economics graduate, was a financial analyst for a major Wall Street firm, and was chief financial officer of a publicly traded company for over a decade. Since his release in 2019, he has been building the Roadside Scholar financial education brand, including CEO coaching for several private companies, and in late 2020, initiating the Roadside Scholar Fund Scholarship Program to assist young adults in starting on the path to building generational wealth. Married and the father of 3, he lives in the San Francisco Bay Area. We would love to ask Adam and Brad your questions. Please post questions and comments in a comment right under this post. And now I'd like to welcome Charlie, Adam, and Brad.
Well, thank you very much, Elizabeth, and thanks for including us. Last week with Lori and Ken Heisey, we took a look at retirement for people who were retired or thinking about retiring. But this week, we are instead taking a look at financial literacy for people who are 20-something and 30-something, or maybe even a little bit younger if you want to start in your teens. And I can't think of 2 individuals who I think can better explain the basics. If you read Adam's column at Humble Dollar every week, it's very readable, understandable, even for somebody with my lack of financial acumen. It's tremendous advice. And Brad Stinn's book, The Roadside Scholar for My Money, is the best book on personal finance in the last 3 or 4 years. It's based on the course that he taught in prison, as you mentioned, Elizabeth, and it's also very understandable, but it's also, just like Adam, it relies on the latest research. Both of these guys do their homework. They accumulate information from a variety of sources, and then they synthesize it so that we can all figure it out. And I'm so happy when we were in February thinking about who would we get to help the younger viewers in the St. Charles City County Library program. The first 2 names I thought of were Brad Stinn and Adam Grossman. I'm so happy they could both join us. And well, why don't we start with the basics? If you are, let's say, 20-something, Brad, you're going to need some cash flow. So you can't start investing if you don't have some money. But isn't the real key to start saving. You have some money. You may not be able to buy the new automobile. Maybe you got to buy the used one. Maybe you got to iron your own shirts a little bit as opposed to going to the dry cleaners. I mean, is that all part of the thinking that someone who's going to accumulate a lot of money has to start adopting?
I think it is part of the thinking, Charlie. But I think rather than thinking about it in terms of less fun, I think you should think about it. One should think about it in terms of priority. You just make yourself and building financial strength for yourself a priority. And if you make that a priority, then certain things become less important. But with my own kids, when I started them out at 18, their reaction was, Dad, you're talking about having less fun. I said, no, I'm really not. I'm actually talking about expanding your choices in life with just a little bit of planning. Doesn't take that much.
Adam, there was a book some years ago, The Millionaire Next Door, and it pointed out that, a lot of people you wouldn't think were millionaires really were because of the habits that they had used through the years.
That's absolutely true. And, people have debated about whether that's a real phenomenon. And in part, it's because it's hard to prove. The concept of the millionaire next door is that the person who lives in the ordinary house next door and drives an average car is the millionaire. And it may not be obvious, they don't look like millionaires, but it's precisely because they're living below their means that they are able to build wealth. And the key point is you don't need to have a super high income. You don't need to be in the top 1% in order to build wealth. But really, you can build wealth simply by living below your means at whatever income level you are at.
And Brad, in your book and research, you figured out that if somebody is 18 years old and that person starts saving $100 a month, what happens by the age of 65?
You could be a millionaire. If you save $100 a month, you start with as little as $2,000 or $3,000, and then add 100 a month and do it long enough, you can be a millionaire just by doing that modest amount.
And Adam, I think the first time I interviewed you, you talked about the value or the principle of compounding. I think I got this from a Humble Dollar column. What happens to a penny when you start doubling it every day? Can you kind of explain that concept in layman's terms?
Sure. So the principle of compounding is that everyone knows that you can earn an interest rate if you put money in the bank, or maybe a rate of return if you're saving in the stock market. But what people find is more difficult mathematically to kind of comprehend, certainly to do the math in your head, is to think about what happens when you earn some money and then that money grows further, and then it keeps compounding is the term. It kind of grows like a snowball. And so, if you start with a penny on day one, it's 2 cents the next day. If it doubles, that's 4 cents. Well, after 10 days, that penny turns into $5. After 20 days, that penny turns into $5,000. Here's the crazy thing. After 30 days, that penny turns into $5 million. And obviously it's hard to find something that doubles every day, but that's the general principle, is that things grow much more quickly once they start to snowball than you ever might have guessed.
And this is a really important concept that's kind of hard for us guys to get our brains wrapped around. Compounding. It almost doesn't make sense. I bet people don't believe what Adam just said, Brad.
You're absolutely right, Charlie. One of the things I do with the Roadside Scholar Fund scholarship young adults that we're using, I take them on bankrate.com. They have an investment calculator, and there's about 4 inputs, and we play with the inputs, and the reaction from all of them is, this can't be true. The math can't be right. And their eyes get big and wide, and the next reaction is, oh, I can do that. That's okay. I can do that. And it's really fun because the math is really hard. One of the things that I found is, rather than and I try to do this in the book clearly, but rather than talking percentages, which I don't think people naturally grasp as well, we talk about dollars, what $1,000 turns into at a certain rate, or 10,000 turns into at a certain rate. And it is, as Adam mentioned, the math is staggering if you can do it long enough.
Well, talk a little bit about that then. What is the math? Let's say I start putting money in somewhere, or maybe we should back up a little bit. How does somebody get in the game? What are the first steps? If I buy that, compounding's good. I studied that a little bit in mathematics in high school or college, but what's the first thing I do if I'm, let's say, 22 to 30 years old and I want to become an investor?
Well, I spent a lot of time in the book talking about that, Charlie, and you have to take the first step. Don't overthink the second step or the third or multiple steps down the road. Open the account. That in and of itself is a highly intimidating process for a lot of people. But once you do that positive behavior, it can lead, and it naturally starts a progression and leads to the next positive behavior, which is what you talked about earlier. Okay, I've got the account open. Now what am I going to do? Well, I got to put some money in it. You can start in today's world due to the democratization, what I and others, many others call the democratization of investing. You can start investing with as little as $20 or $25. And once you do that, then you say, okay, well, I can do more than that. And it starts to snowball. So one step leads to the other. One positive behavior leads to other positive behaviors. All of them are a little intimidating. And so doing one and not worrying about the others, I think helps cut down the intimidation factor.
Now, Adam, when Brad says, let's start an account, is he talking about a checking account, a savings account? What's an account, and where do we go to get one?
There are different types of accounts, and there are standard investment accounts available from all of the big names that you may have heard of. So that might be Vanguard or Charles Schwab, Fidelity. And you can go to any of these websites and open an account online. And so what's an account? Well, the two major categories are retirement accounts and what they would call just a taxable account, a non-retirement account. For most people, my advice is a Roth IRA. So an IRA is an individual retirement account. And the Roth part means that when you put your money in, it then grows tax-free. And so Brad was describing, if you put $100 a month in, whatever you're able to save, if you put that in with a Roth IRA, it can grow over time. And when you withdraw it in retirement, all of that growth over all those years is free of tax. And so from my way of thinking, the Roth IRA is the best type of account. So there are multiple types of accounts, but that would be my starting point. And then once you have the account open, there's a question of which investments you choose for it. But that's the definition of an account in my view.
Brad, do you agree with that? And then if you do get your money into a Vanguard or a Schwab account, I guess you have to choose what vehicle you're going to put your money into. What recommendations might you have? Should I buy Microsoft stock or Apple or Facebook? What do you think?
Well, I think Adam's 100% right in terms of the accounts. There are multiple ones. It can be a little confusing, but the Roth is a great choice to start with. And then in terms of investing, I recommend, maybe because I was such a bad stock picker, I would have been the one buying GameStop at 425. It's currently at 180. And I would have lost 3/4 of my money. So because I was so bad, I defaulted to trying to buy what we call in the book bundles. So for one price, you get a bunch of different stocks that change out periodically on an automatic basis. And you're making a bet like, instead of buying, I think a company is going to last and be great for 50 years. You're saying, I'm buying the US economy. So these bundles, you can buy the US economy, or you can buy a segment of the US economy. And the individual doesn't have to spend any more time, have to do any analysis. and yet you're growing your wealth every day. There are no guarantees on what that rate of return is when you invest in ownership assets, but it's in today's world, it's very simple to do that.
Well, Adam, what if I was 22 years old with $25 to $1,000 to put into my account, my Roth IRA at Schwab or Fidelity or Vanguard? Where do you suggest I put it?
I completely agree with Brad. The concept of the bundle, if you look for, the generic industry term is an index fund. And if you look on any of those brokers' websites, you can find a total market index fund. So it'd be the total US stock market. So it's all the big companies that you mentioned, Apple and Microsoft and Amazon, you get all those, but you also get hundreds of mid-sized companies and hundreds of small companies. And it's all wrapped into one, and just look for the words total stock market index fund.
Should there be some sort of index fund that has not just the whole US economy, big companies, small companies, mid-sized companies, but also international companies, Asia and Europe?
There's a lot of debate about that. In my opinion, yes, it's helpful to include international companies, but if you want to keep things simple, as a starting point, you could just look for a total US stock market. If you wanted to make things more interesting and diversify, there are funds that are called total international stock market index funds. And those are a great choice too.
Do you agree about the foreign exposure, Brad?
Absolutely. I agree that it's both a good thing to consider, but I also agree that it adds the intimidation factor. I'm all about kind of reducing that to speed up decision-making and positive steps. And a lot of people are just more comfortable investing in the US. And fortunately, even today, we're the best or one of the best economies in the world, and doing so doesn't hurt you. So I have run across a fair number of people who, the prospect of going international doesn't scare them necessarily, but makes them a little more uneasy. I don't think you can leave that out. If you leave that part out, you're not going to kill yourself financially.
I have to say, as the 30-something here, yeah, the whole emotional factor of like terror of doing this is very real. I read Brad's book and I was like, yeah, I can do that. And then I think the phrasing was like, okay, walk away and do it. And I was like, no, I can't.
Well, we got to get you over that.
I know.
I volunteer to sit down with you and we can walk through opening in the account.
Perfect. Okay. All right, good. Because I will need that.
Guys, and Elizabeth, I think it was a little easier before COVID where you could walk into Schwab. Mm-hmm. I don't know if Vanguard had any offices here in the St. Louis area. They might, I don't know. But now you got to do it online, right? Mm-hmm. So Elizabeth's a little bit more on her own, but maybe soon the Schwab offices will be opening again and she could walk down and someone there would be able to walk her through the opening steps.
That's in the old days, you could do the old days being pre-COVID. That's absolutely right. Fidelity or Schwab had offices and you could go there and they'd help you open up.
Well, sorry, go ahead, Elizabeth. Sorry.
Oh, okay. Yeah, I just have a clarification question on on opening up an account. And then as far as the index funds go, is if you go to Fidelity or Charles Schwab, do they have a choice of index funds or like in the US economy, or is it just one index fund? I'm just wondering of like how many choices I'm going to make.
Great question.
I can address that. All of the big companies have their own lines of index funds. So certainly Fidelity does, Schwab does, and Vanguard does, the ones that I mentioned. And in general, those are all safe choices. Mm-hmm. There are some companies which have index funds that end up being overpriced and maybe are not great choices. So you do have to be careful. One of the things that people advise looking at is what they call the expense ratio, which is effectively the price of the fund. But if you wanted to keep things simple and reduce the risk of going astray, if you just stuck with the Vanguard, Fidelity, or Schwab lines of index funds and look for that total stock market fund, I think you'd have a great result.
Boy, and that little expense ratio is important because you'll take a look at an index fund, guys, and it could be, 1.5% annually that the company takes for the privilege of investing your money. And 1.5%, frankly, doesn't seem like a lot of money, but you can get it much lower to, let's say, 0.08% or 0.1%. So it's 0.1%. And I guess I was kind of being facetious, Adam, when I said that 1.5% doesn't seem like a lot of money, but it's been demonstrated over a period of 40 years that 1.5% can have a huge effect on how much money the retiree will have at age 65 or 70.
That's very true, Charlie. And if you think about it, the US stock market historically, going back about 100 years, has returned about 10% on average per year. And so if you're paying a fund company 1% or more, then you're effectively giving up 10% of your profits. And so, as you said, if you can reduce that to just a fraction of a percent, then you're in a zero-sum game, as they say, with Wall Street. So that means there's more that remains in your account to grow.
Brad, how important do you think it is for people to keep their expenses when it comes to investing as low as possible?
Oh, Charlie, it's hugely important because Adam touched on a great thought process, which is the investor needs to think about what goes into their pocket after all the expenses. So the trading commissions, the management fees, as well as the taxes. So his earlier comment was how to avoid not avoid, but how to take advantage of the tax laws. We don't want to suggest that there's any avoidance going on, but take advantage of minimizing your taxes, take advantage of keeping your rates, your expense ratios low. All that does is put more money in your pocket. So your hard-earned dollar that you put in, you get to keep more at the end of the day if you focus just a little bit on those two components that he's touched on already. Mm-hmm. And it's dramatic. The numbers are dramatic.
When Elizabeth takes a look at her choices, some will be index funds and some are what are called ETFs or exchange traded funds. What's the difference and what should Elizabeth opt for?
Well, go ahead, Adam. Sorry.
Well, I'll just quickly start. I would say, that an exchange traded fund and an index fund, they're close cousins. And so I mentioned those three big companies that all offer their lines of index funds. They also offer index ETFs. And so you can find a total stock market index fund and you can find a total stock market ETF. And they are very, very similar. I think that traditional index funds, mutual funds, are the simpler choice. And they also allow you to set up automatic investments. So if you said, I can afford to invest $100 a month, say, you could go to the Vanguard website and set up an automated investment, and it will take $100 from your bank account and put it into an index fund each month. And that works with their index funds, but not their ETFs. So that would be one difference.
Do you concur, Brad?
Absolutely. Adam's right on point on all of that. The only thing I would add is that if you do open an account that is in a taxable account, what they call a regular brokerage account, not a Roth or a regular IRA, then I would recommend doing the ETF structure over a regular mutual fund structure. And the reason for that is that the tax benefits are substantially better in terms of the ETF over the mutual fund. So that would be the only thing I'd add.
I don't want to get too personal, Elizabeth, but does your employer offer a 401k or a 403b or?
Yeah, 457.
457.
Because we're public library, so that's so we have that. Yeah.
And have you dipped your toes in those waters yet?
Well, yes, I'm saving. Yeah. But I'm getting the match as far as what they're providing. Is that what you mean? Yeah. Yep. Okay. Yes. So I have that account already going.
And Brad, what percentage do you think that someone like Elizabeth should be putting into that account? And then when inside that account, what investment choices should Elizabeth be making?
I think in terms of contribution, most people should contribute that amount that gets them the whole match.
Right. Yeah.
So whatever that minimum amount is to get every dollar that your employer will give you, I think is a no-brainer.
Yeah.
After that, it's really up to, to the individual. And in terms of investments, I think Adam would agree. Well, I don't want to put words in his mouth, but I think the type of account doesn't matter as much relative to what you buy. So what you buy should be based on what you think is a prudent decision and your time frame. I don't think whether it's a 401k, a 401, all those other formats, or an IRA, or even a regular account to some degree, I think, prudent decisions need to be made. And that means setting your time frame, getting the right balance between stocks and bonds, and keeping your taxes you don't have to worry about in that kind of an account, but you keep your expenses low and you'll do great.
But Elizabeth's driving to work, Adam, and she hears a commercial on KMOX radio. This is a great time to buy gold and silver. And it's a good hedge against inflation, and it's just going to be going up, up, up. Maybe she should take some of her money and buy those or some other commodity. What do you say?
Well, gold has been an investment, for thousands of years, right? And so it seems like something that should be a good idea. Unfortunately, what the data shows is that gold actually has not been a great investment over time. There have been long stretches where the price effectively went nowhere. And a big part of the reason is that gold doesn't produce anything. So if you think about the other kinds of investments that are available, when you buy a stock, you're buying part of a company, and there are people there going to work every day generating profits. If you buy a bond, it pays interest. If you own real estate, say you own an apartment building, that generates rent. But gold doesn't produce anything. It just sits there, and it's only worth what the next person might be willing to pay for it. And so for that reason, the price is very, very unpredictable.
How about
Brad? I'm sorry, go ahead, Elizabeth.
How about investing in, buying your own house, or investing in I guess as a, 20-something, 30-something, when you're thinking about, buying your first home, or when should I pay off student debt first versus investing, or kind of those, what are your advice on kind of those three things? Those are big decisions to balance against investing.
Well, I'm a big fan of ownership assets, period. So I'm a big fan of owning a home, particularly at these low interest rates. I'm a big fan of investing and building for the future. And in both cases, I call that ownership assets. Paying off student debt, that's a more problematic. I mean, in my mind, if the rates are low and you can handle the interest, I think in many cases, you'll do better investing in ownership assets. However, people have to be able to sleep at night. And if the debt is keeping you from sleeping and is weighing on your mind during the day and keeping you from sleeping, then paying down debt is generally not a bad idea, because in both cases, whether your assets appreciating or you're paying down debt, you're building your net worth. And that, I think, is a very personal, what is your relationship with money and risk? I think that's a personal decision for everybody.
It hasn't disrupted my sleep yet, but it does weigh on my mind during the day. So it might get in there.
Well, Elizabeth has 2 master's degrees, so we can only speculate. But here's the deal. What if, and I'm not saying you do, but what if, Adam, she has credit card debt, and the choices are fund the 457, or buy a house, or pay off the Visa, the MasterCard? What should be her first choice?
Well, generally, credit card debt is the most destructive thing to your finances, because the rate is so high. And, we talked earlier about the concept of compounding and snowballing. Well, when you have debt, that snowball is working against you instead of for you. So it's working in favor of the credit card company, but against you as the consumer. So, in general, I would say if you can tackle credit card debt first, that makes the most sense. But that said, I think one of Brad's principles is just do it now, just get started. And so I also don't think that it's illogical if you have credit card debt and you have student loan debt to also say, well, you know what, I have a certain number of dollars per month and I'm not just going to allocate it all to debt pay down, but I'll also start building some savings myself, using something like an IRA that we discussed.
Now, we've got to be careful when we talk about savings, Brad, because you do not like savings accounts.
Mhm.
Well, what I don't like is what savings accounts pay. And a lot of people when I started teaching, there was a lot of folks that I ran into who their concept of doing the right thing from a financial point of view stopped at saving the money, which, is a great first step, no question about it. You have to do that. You referred to that earlier, but they didn't appreciate the fact that if they just left the money in a savings account, where a bank typically pays you less than the rate of inflation, that you are effectively losing money every year. So I nicknamed it, to try and get attention, get them to stop throwing things at me in the class, I nicknamed it the guaranteed losing account. Because if you leave it in there and inflation is, say, 2.5% a year and you're getting 0.2% from the bank, you're losing a little over 2% of your money, your purchasing power, every single year. And people aren't taught that. Only 11 states in the United States require any type of financial education to graduate from high school.
That really surprised me. I mean, I lived in a state that didn't have any financial education, but both of you brought that up, and Brad in your book, and then Adam in one of your blogs, about how poor the financial education is in this country. And that had not hit home to me. Do you have any recommendations for how to fix that? Like, do you think it should be in all states required curriculum, or is it something that is like a familial, you're something that you think parents should do? What's your suggestions? Yes,
it's a great question. And, certainly, people can debate about, well, what should be taught in that class? And if you teach a 17-year-old something, will they really remember it when they're 23 and, finally have a job and earning money and able to save? Well, I think you have to start somewhere. And so, to me, it's funny that we don't teach nutrition, we don't teach about parenting, we don't teach about finances, we don't teach basic life skills in school. So yeah, we should definitely start.
I agree with Adam. And when I came out, one of the missions of the Roadside Scholar is to try and move the needle on education. And I started talking to educators, and I realized how hard it was going to be for me to change their curriculums. There's just so much, there's so little time in the day. Everybody in those systems, both private and public, are overworked, working hard. It's just I just concluded it was super hard. So what I concluded, I was going to try and just start doing something and helping one person at a time, and just see how many pebbles, if you will, we could throw in the pond and how many ripples we can have. Because I concluded that trying to change the educational system was just well beyond my talents.
Well, let me say something. You guys have espoused a theory of people buying in the market generally through the ETFs or the mutual index funds, but that is so contrary to what people had learned 40 years ago. We used to watch Louis Rukeyser Friday nights on Channel 9, and it was, the Wall Street Week in Review, and he would recommend stocks. And Warren Buffett bought individual stocks. Peter Lynch bought individual stocks. Jim Cramer bought individual stocks. Motley Fool, individual stocks. They didn't talk about ETFs and mutual funds. How are you guys going against the status quo by not telling Elizabeth to, hey, go invest in Facebook, go invest in Amazon.com. Why aren't you doing that?
Why don't, what we want Elizabeth to invest in all of those names. When you buy the bundle, you get Facebook, Amazon, Google, but you also get Bank of America and General Motors and Boeing and et cetera, you know, Anheuser-Busch, the St. Louis company, and everything.
You know, one of the things that's changed, you know, why did something that worked for Warren Buffett maybe not end up being the best advice for people today? And one of the reasons is, frankly, the internet. You know, the fact that we can be doing something like this has also had an effect on investing. And so, you know, there are stories about this fellow, Benjamin Graham, who was Warren Buffett's teacher and mentor. And he was arguably the first hedge fund manager back in the day. And, you know, he described going to Washington, take the train to Washington, go to a government office, dig through documents and filing cabinets to find information about railroads and, you know, copy this information down on paper. Today, that information is available on the internet from your desk. And what that has done is democratized information. And so it's much harder to do well buying individual stocks because the same information is available to everybody. You don't need to get on the train and go dig through filing cabinets. So that's one thing that's really changed.
Very interesting.
Well, and I think if I can add one thing, Charlie, to that, I think you know, part of the issue is time and training. So, you know, Elizabeth has 2 masters. She doesn't want to get a third in finance. She doesn't want to become a financial analyst. So how can Elizabeth, who's a super smart individual, smarter, no, with no disrespect to you, 2 other gentlemen, much smarter than us, we're not trying to convince her to be a finance, you know, master's degree candidate. We just want her to start following her own enlightened self-interest. And so she doesn't do, you know, when you're analyzing individual stocks, you don't want to spend, most people don't want to spend the kind of time that Warren Buffett and these other folks have done and have to do in today's world to try and get any kind of an edge.
Mm-hmm.
Well, I think we have time for viewer questions. Elizabeth, have you garnered some?
I have, yes. This one's coming up from Julie here. And Julie asks, oh, hold on, I just lost it. Whoop, sorry. Okay, from Julie here. Do you recommend starting or putting an emergency fund in something other than a traditional bank savings account?
Well, I can address that. I'll entirely agree with Brad that, you know, putting money in the bank is a losing proposition. You're losing to inflation. But I think that Julie raises a good point, which is that certainly if you're talking about having a rainy day fund, then the bank is the best alternative. You don't want to be risking money in the stock market that you might need, you know, for the proverbial broken boiler or a car repair or whatnot. There are, however, banks that pay more than others. And if you look online, generally the category is high yield savings accounts. And there are banks that don't have branches. And because they don't have branches and they're online only, they're able to pay much higher interest rates. Now, all rates are low these days, but if you can do better than someplace else, you certainly want to earn whatever you can. So high yield online savings accounts is what I would recommend.
And should Julie have 4 months or 6 months of spending in that account? Any recommendations, guys?
I would say, again, it's a personal matter. What makes her feel comfortable? Some people recommend 4, some people recommend a year of, say, your rent or something, depending on what keeps you comfortable. And I echo Adam's concept. I think the way to think about it is, what is the likely, or maybe unlikely, but what is the short-term need for the money? Most of what I talk about in the Roadside Scholar is trying to build long-term wealth. So you'd only put in that capital account the stuff that you don't want to touch, the money that you don't want to touch, for as long as you can let it compound.
And when you say banks, are credit unions under that term, or are they kind of a separate, lesser, do they definitely yield less?
Credit
Or-
unions are in that same category. Generally, they serve the same function. They
Okay.
pay interest on an account
Mhm.
held in cash. They provide insurance in the FDIC, meaning it's government insured if the bank or the credit union were to fail. But the credit unions, again, I think what you need to look for is not necessarily whether it's a bank or a credit union, but what is the interest rate that they're paying and to shop around. Brad mentioned earlier Bankrate. Bankrate's a great website, free website, and you can search for interest rates and comparison shop.
If someone has money in an account that's easily available, that's liquidity. You're able to get that cash without selling something, and you can get it in a moment's notice. How much money do you think young people should have on the side, if any, guys, just in case this stock market takes a 25% dive and all those stock market prices go down 25%, kind of making the stocks cheaper and more affordable and more attractive? Should the young investor have a little cash available just in case there's a market plunge?
Well, it's a good question. I think conceptually there ought to be two categories, right? We talked about like opening a retirement account, and those funds are for the long term. We talked about an emergency account on the other hand, and that's for something that comes up. And it seems to me that they should each be invested according to those specific goals. And so the emergency fund should be in cash and only cash. And I think that for a retirement account, or if you're a young person, you're just starting to save, I think it can all be in stocks, and you don't need to sit and try and decide that, well, maybe I'll have some cash on the side in case the market goes down, because I think you can fall into the trap that Brad is talking about, which is that you can be sitting and waiting and trying to guess, is the market going to go down next, or is it going to keep going up? I think that if it's going into a retirement account, just invest it in stocks if you're a young person, and don't worry about trying to fine tune it too much.
Agreed.
Okay, another question, Elizabeth?
Yeah, actually, I have one follow-up to that one quick, but audience members, yeah, please ask more questions. We'd love to get you some answers to your index funds, mutual funds, ETFs, whatever isn't clear. I have a question on so if I have, say I have this 457 through where I work, should I have like a couple other accounts? Like, should I open one through Fidelity as well? Or is that kind of extra? Should you just go with one, or like, should you open one with Fidelity and Charles Schwab, or is the more better?
I would say that you don't really need more brokerage relationships. You don't need Fidelity and Charles Schwab necessarily.
Okay.
I think the issue you're referring to may come down, however, to how much you contribute in a year. So usually in these tax advantaged accounts, there's dollar limits on an annual basis.
Oh, sure.
If you run up against that limit, then you may be required to open another account if you want to save more. And I would recommend saving as much as you possibly can, as young as you possibly can, for reasons of compounding, because time is your friend in investing. So I think the issue of having multiple accounts is more about how much you're able to save in any one particular year, and if you run up against the limits on those tax advantaged accounts.
And I will say, I don't know what your experience is, gentlemen, but I've been doing some work recently with Schwab. The website is very understandable. They have very good telephone customer service. Their their prices are low, and we talked about expenses earlier. I can't speak for Fidelity. I don't use them. I have an account with Vanguard. They've been excellent also. Do you have any recommendations?
I would say that those two are both excellent. And one of the things that can be a little bit confusing is that each of those companies has their own line of funds, of index funds, but they're also brokers, meaning that that's where you would go to open an account and to buy things. But it doesn't mean that if you open an account at Vanguard, for example, that you can only buy Vanguard funds, or that if you open an account at Fidelity, that you have to buy Fidelity funds. And so it can be a little bit confusing in that sense. But I think that any of those big three that we've talked about will work fine. And just don't feel that you're limited to that company's offerings, though.
One thing, Charlie, I would throw out there, particularly since we are talking about advice for young adults, is the firm Robinhood. I speak to a fair number of young folks in my daily travels, and all of them seem to be aware of Robinhood. It is, particularly in the last 3 or 4 months, it has become a super hot name of a brokerage account. And so about a month ago, I actually opened up a Robinhood account because I wanted to see what it was all about. And it's very different than those other accounts in terms of the feel of the website. So I think we would be remiss if we didn't maybe discuss Robinhood and talk about it.
Yeah, what was your experience with it, Brad?
It was really very positive. At first glance, it seemed very video gamey, and they do what appears to me, being a bit of a cynic, a lot of things to try and promote trading. But I opened the account. I opened it with $200, so not a ton of money. And literally within 15 minutes, I got a notification, or maybe it was right as I was online. But the whole thing took me a few minutes, and they gave me a share of stock for opening the account and transferring money that day. And they did it in a way where they did it on screen, this little shell game, and you had to pick one of the 3 shells. And I picked one. It happened to be a share of Microsoft. So my $200 got doubled in 15 minutes. So my initial experience was quite positive. That was 4 months ago. And I've contributed more money. They don't charge fees. Their execution seems good, but it's a completely different feel. And I think they do get criticized a bit by more stodgy finance types, because the setup just feels like they're trying to promote trading more than the others.
Do you have any experience with Robinhood, Adam?
I've tried it also, and I would agree with Brad's description. It's very engaging, and I think that their mission was to try and bring people into the world of saving and investing, where maybe they were put off by some of the bigger companies. Historically, we talked about the differences between index funds and index ETFs. Historically, index funds had minimums which were quite high. At Vanguard, for a long time, they were $3,000 to get started. And at Robinhood, you can get started with just a few dollars. One of the things that's been very interesting is that Robinhood has actually put pressure on all of the traditional firms. And so they have all dropped their prices, and commissions have gone away for the most part at all of those big 3 traditional firms that we talked about.
Mm-hmm. Well, I'll tell you, when you were at Schwab and you were buying, an ETF, there might be a $9 fee. Have they eliminated that?
Most recently it was $4.95, and then it went to $0 about a year ago.
Wow. Okay.
Yeah.
Well, competition is a good thing, is it not?
It works.
We have another viewer question. We talked earlier about being able to go in person and how that has been halted because of COVID. But this customer wants to know if you can do everything online from home as far as investing in Fidelity or Charles Schwab. You don't have to ever talk to a person. So like for us introverts, if you wanted to, is that true? You could just do everything online at home?
Absolutely.
Okay.
Absolutely true.
Okay. I have a follow-up here. Adam, you mentioned brokers at like Fidelity or Charles Schwab, and then your company is a flat fee based. So when you're looking for either, advice on this topic or going to, Fidelity as far as the broker fees, so I guess this is kind of two separate topics, but what should you be looking for when you're thinking or considering the broker fees? And are there any red flags to look away from and that kind of thing? And then as far as like kind of financial planning advice, if you go to a company like yours at Mayport, what should you look for?
The key term, in my view, is the word fiduciary. And so there are all kinds of people in the world who are financial advisors in one way or another. There are insurance brokers, traditional stockbrokers. There are people who just go by the generic term investment advisor. There are advisors at banks. If you just walk into a traditional bank, there'll probably be people who open a retirement account for you. So to me, the key question is, are you a fiduciary? And that is a separation, which it's sort of a legal term, but it's important. And basically what it means is that you're putting the customer's interests ahead of your own. So it sounds like that ought to be something that you expect that should be a given, but unfortunately it is not. And so there are, at a lot of firms, there are certain kinds of people who are really just salespeople. And so the analogy I make is, if you walk into a Honda dealership, you understand that they're going to try and sell you a Honda, not anything else. And so that's understood. That conflict of interest is understood. In the financial world, though, that's not always the case. And so you may not realize that someone who's not a fiduciary will be just offering the things that maybe pay in the best commission. So that's the key term.
That is very interesting, because you didn't hear that term really 30 years ago. You had people who were kind of like selling the Hondas and not the competing product. But imagine if your doctor, well, I guess this can be complicated, but you would hope that your doctor has a fiduciary responsibility to you, looking out for your best interest. Hopefully they are. I want to say something, and that is that our viewers can get more information from Adam through the Humble Dollar website. That's called Humble Dollar. It was started by Jonathan Clements, who was the personal finance columnist for the Wall Street Journal. And it's a fantastic free service, and Adam posts a different column every week in understandable, valuable information terms. Brad has written a book that my son has really enjoyed, and my son takes no advice from me whatsoever. And if I had recommended the information in Roadside Scholar, he would have ignored it. But my son, who's now a third-year student in college, read the Roadside Scholar, and he immediately started investing money. And I think it's a great graduation gift if your son, daughter, niece, grandson, whomever is getting out of high school or college. Because as Elizabeth brought up, in fact, Brad, your fellow residents at the correctional center said this to you. Oh, you learned this at school. These are the inside tips that you got in school. They said that to you, but this, for whatever reason, is not available in our schools, is it?
It is not. And that is the difference between, well, not the difference, but the perception, let's say, that certain schools, the kids get taught this, and that's why they go on and are successful financially, and other schools don't. And the people who don't think that are a big percentage because they didn't get it. So there's this perception that's just wrong. And I remember hearing it the first time, and I called home and got my kids on the phone. They were, senior in high school, sophomore in high school, 8th grade. And I asked all three of them, what are you learning in school? And I wasn't there. And they said on this topic, and their response was, what are you talking about? Nothing. And I said, okay, well, here's something that we can do together over the phone. And it really was great for us. But in so doing, I learned that people are starved for this information. Unless you grow up with it, or you're in one of 11 states, you're not going to get it. And so I think the mission of the Humble Dollar and Adam and Charlie, what you and Elizabeth are doing here is really important for our country, because I think not only will people feel more engaged, and I think it will bring us together, because it has nothing to do with skin color or political bias or political orientation, let's put it that way, whether you're red or blue or whatever. It's something that everyone has to deal with. And if everyone's more confident about it and more people are in the system, I think we'll all be better off.
Sure.
Well, thank you, gentlemen. We really appreciate your time. Elizabeth, I'm going to throw this back to you. But again, the Roadside Scholar, Amazing Money Lessons from Behind the Fence, available at Amazon.com. And Mayport Wealth Management is based in Newton. You see, Newton, Mass. We had one guy from MIT, Adam, and the other guy from Harvard, Brad, and we had to separate them by 3,000 miles. Brad's in Boston, Brad's in San Francisco, Adam's in Boston. We had to keep them apart.
Yeah.
But you got to understand, Elizabeth's a Wolverine. She's right down the middle of the country, guys.
Right down, yep.
Go blue.
Yes, well, thank
Actually,
you.
you're also a Badger and a Billiken, now that I think about it.
So a friend and I decided yesterday it was a Badgerine, because I was a Badger first and then a Wolverine, but we couldn't really weave the Billiken in there.
No.
It's a little less fierce of a mascot too, so.
So you're going to pick your next school where you're going to get your third master's by the mascot?
Oh yeah, probably. Yeah. Well, and my high school mascot was a cheesemaker. So, that Wisconsin, and that's yeah.
The cheesemaker.
Cheesemaker, yeah.
So what mascot ran around the football field on Friday nights then? Some guy dressed in like a chef's outfit or something?
One year we had a mouse.
Okay.
And yeah, so that kind of worked. We actually didn't really have one. It was just like big slices of cheese, or like the cheese heads that the Packer fans wear. Like we had those. So, yeah. So anyway, yeah. So, back to Money Smart Monday. So yes, thank you, all three of you gentlemen, for joining us. Thank you, audience, for your questions. And as Charlie said, Brad's book, The Roadside Scholar, is available at our library. We have the links posted in the comments if you'd like to check it out. And you can also buy it at Main Street Books, our local independent bookstore in St. Charles. And Adam's Humble Dollar, that should be posted in the links, as well as his Mayport Financial Resource Library. There will also be shortly a link to a survey for tonight's Money Smart event. We'd love to know what you think we're doing well and what we should keep doing, and then where we can improve. Everyone that completes the survey and includes their email address will be entered into a drawing for a $50 gift card. A total of 5 gift cards will be given away based on a random drawing, and the winners will be notified by May 14th. I hope you've had a wonderful, informative evening. Our next Money Smart Monday will be on April 26th at 7 p.m. right here on Facebook Live. We welcome Ron Lieber, a New York Times personal finance columnist and author of several books. We'll chat about his new release, The Price You Pay for College, an entirely new roadmap for the biggest financial decision your family will ever make. We have a new online events calendar. It's the same place on our website, but it will look a little different. If you have any questions at all about navigating, please feel free to reach out to us on Ask Us or call your local branch. Thank you so much for joining us, and have a wonderful evening.